Welcome to Iron Financial. We're here to do one thing, forge stronger portfolios. And we do that by putting market titans under the microscope. Today, we're targeting a company so deeply woven into the fabric of the American dream, it's practically part of the foundation, Fannie Mae. This government-sponsored enterprise is supposed to be the absolute bedrock of our housing finance system. You know the thinking. A strong Fannie Mae means a healthy housing market, and that in turn fuels a stronger American economy. But is this titan really, truly built to last? We're about to put it through a serious stress test and find out.
Right. Let's just cut straight through all the noise. Fannie Mae. It's a name that everybody knows. It's completely synonymous with homeownership in America. But when you start to peel back the layers of their latest earnings report, you start to see this weird disconnect, a gap between the big, flashy headlines and how the market's actually reacting. So the question we are going to answer today is pretty simple when you boil it all down. Is Fannie Mae a rock-solid foundation you can build a portfolio on, or is it just a crumbling facade hiding some serious fractures that could bring the whole thing crashing down?
Okay, so let's get into it. To really understand the conflict here, we have to start by building the bull case. You have to respect the raw power in these numbers. You really do. We are talking about the ironclad headlines, the top-line figures that just scream stability, profitability, and, frankly, immense financial strength. These are the numbers that management really wants you to focus on. And, to be fair, they are incredibly impressive.
Let's just start with the bottom line, the number that everyone looks at first. For the entire year of 2025, Fannie Mae pulled in a staggering $14.4 billion in net income. And no, that is not a typo. For a government-sponsored enterprise, that level of profitability, it really speaks to the unbelievable scale and efficiency of their entire operation. I mean, this isn't some speculative tech company burning through cash. This is a financial powerhouse that is just printing money. But you know, 1 year's profit, that's just a snapshot in time. The real story of strength, the deep story, is always on the balance sheet. And just look at this number. Their net worth has been systematically, deliberately built up to an incredible $109 billion. And what's even more important than the number itself is the velocity, the speed of this buildup. Since just the beginning of 2020, they've added a mind-boggling $95.5 billion to that net worth. This tells you they are aggressively retaining their earnings and fortifying their capital base like their life depends on it.
I mean, just look at this chart. Look at that relentless upward trajectory. This is not a fluke. It's not an accident. This is a deliberate multi-year campaign of fortification. They went from just over $25 billion in 2020 to nearly $110 billion today. In just 5 years, they have more than quadrupled their capital cushion. This is a fortress being built, brick by heavy, heavy brick, right in front of our eyes.
And what about consistency? In a world this volatile, consistency is king, right? This number, 14, it represents 14 consecutive years of annual profitability. Just stop and think for a second about everything the market has been through in that time. We're talking interest rate hikes, crazy housing market swings, major economic shocks. And through all of that chaos, Fannie Mae has stayed in the black for 14 straight years. That is not luck. That is a battle-tested, resilient business model that has proven, time and again, its ability to manage risk over the long haul.
And, to cap off this whole bull case, here's the official story right from the CFO, Chris Halley. We are well-positioned while operating in a safe and sound manner. It's a story of strength, of stability, of sound management. But hold on. Those words, safe and sound, those are the exact words that should make every single investor pause and lean in a little closer. We've all seen this movie before, haven't we? We've seen how impressive numbers can be used to mask some pretty serious underlying problems. So, are we really looking at an impenetrable fortress here? Or is this just a very carefully constructed facade? Now that is the right question. And to answer it, you can't just look at the headlines. You've got to get under the hood. You have to inspect the engine itself. So let's drill down into the absolute core of Fannie Mae's operations, the very heart of this machine, to see where all this consistent strength is really coming from. We're talking about the guarantee business. And what you find is that this engine is remarkably consistent. Just look at these revenue numbers. They're almost flat, quarter after quarter. You've got $7.3 billion in Q4, a massive $29 billion for the full year. This isn't some volatile revenue that depends on them hitting a home run every quarter. No, this is steady, predictable, almost boring income. And it's all driven by guarantee fees they charge on their colossal $4.1 trillion book of business. Think about it like a massive recurring toll road for the entire U.S. mortgage market. Every single month, those tolls just keep coming in. Now, the main turbine of this entire engine is without a doubt this single-family segment. It generated $6.1 billion in net revenues in the fourth quarter alone. It is the absolute bedrock. But the multifamily business is still a really significant contributor too, pulling in $1.2 billion in revenues. So you've got this diversified, powerful, and incredibly stable revenue machine humming along.
And that's the point right there. The sheer scale is just breathtaking. 25%. Let that sink in. 1/4 of all single-family mortgage debt in the entire United States. That's not just a big company. That is a piece of critical national infrastructure. It's a systemic pillar of the whole economy. And that means if cracks, even really small ones, start to appear in this foundation, the entire structure is suddenly at risk. So, the billion-dollar question, the one we're all here for, is still on the table. Are there any cracks? Let's find out. Now it's time to do what we do best here at Iron Financial. It's time to take our hammer to that foundation and start looking for the stress fractures. The bull case, it's built on those shiny ironclad headlines. But the real story, the one that's going to determine future strength, that's often buried in the footnotes, in the subtotals, and most importantly, in the trend lines. So let's go back to net income. The full year profit for 2025 was, as we said, a formidable $14.4 billion. It's a number that most companies on Earth can only dream of hitting. Formidable, yes, but here at Iron Financial, we care about the trend, the direction of travel, and the trend is down. Net income fell 15% year over year. That's a $2.6 billion decline in annual profit. The engine isn't just sputtering a little bit, it's actively losing power. So the critical question becomes, what's causing this erosion? What's going on under the hood? Well, the company's own press release lays out the reasons pretty clearly. First, there was a $1.8 billion negative swing in their provision for credit losses. Now, in plain English, this is an accounting entry that reflects management's own expectation of future defaults. They are setting aside more money because they expect more loans to go bad. That is a major red flag. Second, a $1.7 billion drop in fair value gains. That just means the market value of their financial investments isn't performing as well. And finally, higher administrative expenses are eating into profits. These are not minor adjustments. These are significant headwinds picking up speed. And you know what? It's not just us noticing this change in trajectory. Wall Street noticed it too. The consensus analyst estimate for fourth quarter earnings per share was 68 cents. Fannie Mae delivered 60 cents. That is a classic earnings miss. And when a company of this size, with this much supposed predictability in its core business, misses analyst estimates, well, it tells you that the internal reality is proving to be weaker than even the market's cautious perception. It's a huge external signal that something is shifting under the surface. Now, a bull, a true believer, might point to the rising multifamily net income. And yeah, it was a strong performance, hitting $850 million in the fourth quarter. But rising income is only half the story. The other side of that coin is the rising serious delinquency rate. See what's happening? They're earning more, but they're doing it by taking on more risk, and that risk is starting to bubble to the surface. Let's really focus on this delinquency rate for a second, because this is absolutely critical. It's up from 0.57% to 0.74% in just 1 year. Okay, so the absolute numbers are still pretty low, I'll grant you that. But the trend is a clear warning sign. It points directly to growing stress in the multifamily loan portfolio, which is a segment of the market that everyone on edge right now. The direction of this trend is a major, major concern. Okay, the risks are noted and they are absolutely real. But let's not ignore how management is actively responding to this changing environment. They aren't just sitting idle and hoping for the best. They are reinforcing the walls. They're making specific, defensive moves to try and strengthen the company's operational and financial structure. This is the counterargument to the bear case we just laid out.
Just look at this number, 1,200. That is the approximate number of employees they've cut from 2024 to 2025. This represents a roughly 15% reduction in their total workforce. This is not a minor trimmer on the edges. This is a significant strategic move to get leaner, to strip out costs, and to become more efficient in the face of those headwinds we were just talking about.
And these actions are not just talk. They translate directly into tangible results right on the income statement. A $141 million reduction in year-over-year non-interest expenses. That is disciplined expense management in action. Think about it. Even while they were incurring severance costs from laying all those people off, they still managed to bring their overall expenses down. They are controlling what they can control to protect that bottom line. But that brings us right back to the central question of this entire analysis, doesn't it?
Is this proactive fortification, or is it a purely defensive reaction? I mean, when a company makes cuts this deep, sure, it can be a sign of strength and forward-thinking optimization, but it can also be a signal that they're battening down the hatches because they see a massive storm on the horizon. So which is it? Are they building a stronger fortress for the long term, or are they just desperately bracing for impact from weakening fundamentals that they can see coming? Which brings us right here to the final verdict. We've pressure-tested the bull case. We've hammered on the bear case. We've inspected the foundation, and we've definitely highlighted the cracks. Now it's time to put the complete blueprint on the table side by side, so you have all the critical data points you need to make your own informed decision. So here it is, the final breakdown. On one side, you have the fortress, a staggering $109 billion in net worth, 14 years of uninterrupted profitability, a massive $4.1 trillion guarantee book, and a stable, predictable revenue engine. But on the other side, you have the facade, a 15% decline in net income, rising delinquency rates in a key business segment, and a missed earnings estimate that spooked Wall Street. And here's the kicker, the one detail buried deep in the footnote that changes everything. A $41 billion deficit in their required common equity Tier 1 regulatory capital. CET1, that is the highest quality capital. It's the core measure of a financial institution's ability to absorb unexpected losses. And by their own regulator standards, they are severely undercapitalized. So we're going to leave you with this final provocative question. Is Fannie Mae a foundational asset for your portfolio? Is it a bedrock of stability, an indispensable part of the U.S. housing market that's simply too big to fail? Or is it a ticking time bomb, a facade whose cracks are getting wider by the day, with declining profits, rising risks, and a massive capital hole that has yet to be filled? The evidence is on the table. The decision is yours. Thanks for joining us at Iron Financial. Stay strong.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.